Hello and welcome to the latest Insider interview. Our guest today is Paul Niven, manager of the Super 60 rated F&C Investment Trust. Paul, it's great to have you here.
Thank you.
The trust has been around for about 150 years. It's the oldest investment trust and it's just entered the FTSE 100. So can you tell me a little bit about how it's managed and why it's been so successful?
F&C Investment Trust aims to be a one-stop shop for investors looking for exposure to growth assets, and growth assets are equities and private equity. So we take full advantage of the closed-ended nature of the investment trust structure. So we have some illiquid exposure in there in terms of private markets, around about 10% or so at the present time, and the remainder is invested into large cap liquid equities. And we invest in a diversified manner, and that means that we have a range of underlying investment strategies that we have exposure to geographically, by sector and by style. So for example, within the US, which is the single largest part of our portfolio, we have exposure to both large cap growth stocks like Apple, Microsoft, Amazon and so on, and also large cap value stocks. And we blend and manage those exposures through time in a manner that's consistent with delivery of strong investment outcomes for our shareholders.
And you have about 400 stocks. Does it look very different to the benchmark?
So we operate, as I said, an approach which blends together focused strategies. So we have 8 to 10 individual listed strategies, each of those holding a relatively limited number of stocks. So in the case of Europe, for example, we've got around 40 stocks in our European strategy, around 40 stocks in our large cap value strategy. When you add them together, then you end up, as you said, with a little under 400 stocks. The principle is essentially that returns are additive and risk is not. So blending together those individual strategies in a diversified portfolio should be accretive to returns while actually reducing risk, meaning that the overall performance journey for shareholders should be smoother than taking a stance on one particular segment or area of the market, either geographically, by sector or by style.
Does FTSE 100 status change anything for you? Do you get better access to companies, more internal resources? And what about the press attention? Is anything going to change with the way you now manage the portfolio?
It's very much business as usual in terms of how we invest, where we invest. We've got substantial scale in terms of the investment trust and also the organisation which I work for, Columbia Threadneedle, with $650 billion of assets under management. That gives us great access to corporates. So there'll be no change in terms of where and how we invest. We've got tremendous scale in terms of the resources that we apply to the trust. I manage a team of more than 20 individuals who manage multi-asset portfolios, of which FNC Investment Trust is one. And throughout the organisation, as well as externally, we've got a lot of access to individuals who at the underlying level are picking either securities for us or helping us select managers and individual private equity investments. In terms of the attention is welcome in the sense that we clearly want exposure of the trust as widely as possible. Would deliver very strong returns for shareholders. I think the addition of the trust to the FTSE 100 will hopefully increase attention.
This year the trust has fallen less than your peers. Why is that? Is it because it's more defensive naturally, or have you pivoted to taking less risk as the macroeconomic backdrop has deteriorated?
So year to date it's been a really tough period for investors in equities. As you know, we have lost some value in shareholder total return terms and NAV terms, but against peers, as you said, we delivered good returns. In fact, we're top quartile year to date, 1 year, 3 year, 5 year and 10 year over all those time periods against closed-ended competitors. So it's been a good period of relative performance. We actually made some quite substantial changes to the portfolio over the last couple of years. That's carried on into this year, but essentially pivoting away from expensive large cap growth stocks, predominantly in the US. We've sold around $800 million of large cap growth stocks starting the second half of 2020, and we carried on that process earlier this year. We also reduced our position on emerging markets in last year and into this year, and we sold out completely of global smaller companies this year, which had been around 6% or so of the portfolio. Proceeds predominantly into cash. Actually, we raised cash levels up to about £300 million at the end of the first half. Quite a substantial rise. That reduced our gearing position. We were expecting more difficult markets, and unfortunately that has been the case. And we also reduced a long position that we had on sterling. Sterling has been notably weak at the beginning of 2021. We had a £300 million long position on sterling. That was reduced to £200 million start of this year, and at the end of the first half about £30 million. So quite substantial changes, predominantly raising cash, reducing gearing, shifting out of growth stocks with proceeds predominantly going into cheaper value stocks and those stocks with higher yields.
Can we have some examples of companies you've sold then over the past year or so to reduce that element of growth in the portfolio?
So we, as I said, invest into individual strategies where we hold stocks on in segregated mandates. And for example, we have divested materially from US large cap growth. And as a function of that, we've gone underweight some of those big names in the portfolio, sold out of names like Microsoft, Amazon, Apple, the big names that have obviously had been driving markets up until relatively recently.
You said you increased the cash position. So what percentage is now invested in cash, and where might you deploy some of this capital?
So cash position right now is between 5 and 6% of the overall portfolio. We actually had raised quite substantial cash levels through borrowings actually over the course of the past 18 months or so, securing very low rates of borrowing for an extended period of time, and most of that recent cash raise has been left in cash. And as I said, some of those sales that we've made from large cap growth has also been left in cash. What are we looking for to reinvest? The first half of this year has predominantly been about a de-rating of markets getting cheaper, essentially as there's been a reset in terms of rising inflation and interest rate expectations. Unfortunately, I think that there is still some downside risk to markets, equity markets from here. The reason I believe that is the case is because we are likely to be entering recession in many of the developed economies. And in fact, China looks somewhat problematic as well. And that means there's going to be some pressure on earnings in terms of the corporate earnings outturns from here. That, I think, is likely to place some downside pressure on equity markets in the near term, and therefore what we're looking for to reinvest, better levels of valuation, a more realistic assessment by the market in terms of the growth and inflation outlook, pricing levels more generally, and I think that will take some time, but we're in a good position as and when that unfolds to put that cash to work.
You mentioned recession as one of the main risks. So which types of sectors do you think will be most resilient in terms of profits when there is slower economic growth?
It's a really interesting question because classically one would look to growth sectors in the market, your tech stocks, for example. Typically, any downturn, they will prove more resilient in terms of the corporate earnings that they deliver. Value stocks, which tend to be more cyclical in nature, albeit cheaper, will tend to underperform. And the quality stocks, which have got persistent earnings or free cash flow delivery, will similarly provide typically a good outcome. I think the challenge this time is that quality and growth, the areas that one would typically expect to outperform in a recession, are still trading at quite a high premium relative to the rest of the market. And there's some good examples of that. If you take Apple, trading at something like a 30% premium to the market, that's pretty much as high a premium as one has ever seen. Great company, but like many other growth companies or high quality companies, they're trading at quite high levels of valuation. I think it's difficult to be categorical in terms of which areas will provide the best downside protection. I would fall back on the approach of being diversified in our approach. We do have a bit of a tilt to value. I do think investors will remain value sensitive. We have more by way of capital in higher yielding stocks, which we think will perform relatively well. So we're avoiding those more expensive areas of the market, which remains actually the growth tech, where we have exposure but are below benchmark at the present time.
Paul, thanks very much for coming into the studio.
Thank you.
And that's all we have time for. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.